Are you ready to retire a millionaire, or are you just planning to survive on ramen noodles in your golden retirement years? If you're like most people, you probably heard of a 401k, but maybe you're just not entirely sure what it is, how it works, or how to optimize it. Perhaps you just think it's just something your older, more boring colleagues talk about at work. Let's buckle up because we're about to dive in the most misunderstood world of the 401k, debunk some of the myths along the way. Welcome to my ultimate 401k guide, a deep dive into the world of retirement savings that could be literally saving enough money that represents a yacht in your retirement. If you're just starting out or you're well into your career, understanding the ins and the outs of your 401k can be your secret weapon to not just surviving in retirement, but thriving in it. This is going to be a long, comprehensive video. I'm going to put timestamps below, refer to this video again, and in future, I'm going to also release them in their broken up sections so it's easier to consume. Also, I'd appreciate it if you would please like the video because a lot of time and effort went into making this video and it helps with the YouTube algorithm. And as a thank you, here's a special freestyle dance and a quick disclaimer.
I am not a financial advisor. This is not meant to be financial advice. It should be used for information and educational purposes only. These are my experiences and my opinions. Investing is risky and you can lose money.
Now, are you ready to change your future? Good, let's get started. The origin of the 401k, warts and all. The 401k plan, now a cornerstone of American retirement savings, has a rather interesting origin story. It wasn't initially designed as a mass tool for retirement savings, but rather a tax loophole for executives, and its transformation into what we know as it is today was somewhat accidental. The history of the 401k begins in the late 70s. In 1978, Congress passed the Revenue Act, which included a provision known as Section 401k. This provision was inserted into the legislation to limit executives from taking advantage of cash-deferred plans, which allowed them to dodge taxes on a portion of their income if they agreed to receive it at a later date. The man often credited with the creation of the 401k as we know it is Ted Bernard, a benefits consultant who realized that this provision could be used to create a simple tax advantage way for employees to save for retirement. He noted in the language in the Section 401k didn't just apply to bonuses, but could also include salary. Bernard proposed this idea to his employer, the Johnson Companies, and in 1981, they implemented the first ever 401k plan. The idea was simple. Employees could choose to have a portion of their salary deducted from their paycheck before taxes, which would be invested in the stock market and taxed only when the money was withdrawn at retirement. The concept caught the attention of the IRS and the Treasury Department, and after some deliberation, they decided to permit the 401k plans. Following the IRS issues of guidance on November 1981, other companies started to adopt the plan as well. However, 401k plans didn't immediately replace the traditional pension system. Initially, they were seen as a supplement to pensions, but as the cost of funding pension plans started to increase, companies began phasing out their traditional pension plans in favor of these 401k plans, shifting the burden of saving for retirement from the employer to the employee. Over time, the 401k has evolved with various laws passed to try to improve its structure, increase participation, and protect investors. However, the system still retains much of its original form with its benefits and its flaws deeply rooted in its unique history. So while the 401k is an essential part of American retirement today, it's important to remember that it started as a bit of an accident. An oopsies, a byproduct of a tax loophole that evolved into a fundamental pillar of retirement system today. The harsh truth about your 401k. The 401k, when first introduced in the 1970s as the supposed golden ticket to secure retirement, has proved to be a double-edged sword for many Americans. Hailed as a revolutionary tool for financial independence, it has also revealed a darker side, one that leaves many workers in a precarious position as they approach retirement. The harsh truth about the 401k, it's not a guarantee of comfortable retirement. It has some risk and can feel like a high-stress game of financial roulette, where your future security rests heavily on market performance, your choice of investments, and then your ability to continuously contribute regardless of life's unpredictable twists and turns. Burden of investment risk is entirely on the individual, not the employer or the government. The shift from this defined benefit pension plans to now defined contribution plans like the 401k means that workers, regardless of their financial literacy, are now responsible for their retirement investment decisions. It's a high stakes game where making the wrong move can potentially lead to significant financial loss through not being able to gain as much as you could have if you knew what you were investing in. And their plethora of investment options, fee structures, tax implications can be overwhelming, even for the financially savvy. The system is riddled with hidden fees that eat into your investment returns, turning your retirement savings into a cash cow for financial institutions if you don't know how to navigate it. The promise of a secure retirement shouldn't hinge on someone's ability to navigate these complex waters, but it does. This doesn't mean people should reject the 401k plans outright, but they should approach them with a critical eye and understand their limitations, but also understand how to maximize them. So here are the basics of a 401k and the essentials. The 401k is a type of retirement account you get through your employer. It's like a magic box that helps you grow your money if you use it right. So here we're going to be playing the long game. When you contribute to your 401k, you're making a long-term bet. So it's not about quick cash or instant gratification. It's about building a pile of money that will grow over time so that when you're old and you're gray, it'll be the last thing that you have on your mind. And the way that it works, it's pre-tax dollars. So Uncle Sam can't touch it, at least not yet anyways. This reduces your taxable income now, but there's no such thing as a free lunch. You're gonna have to pay taxes on the money when you take it out later, and we'll go into more of the nuance between that later. The other thing that you get as a benefit in your 401k is tax-free growth. This is where the magic happens. Any earnings from your investments in your 401k grow tax-free. Over decades, this can compound on itself, leading into a sizable nest egg. There is, however, a cap on the contributions you're allowed to put into your 401k. So Uncle Sam has imposed some limits on how much you can contribute. And as of 2023, you can stock up to $22,500 a year if you're under 50. And if you hit the big 50 and you're over, you have the bonus to add an extra $7,500 as a catch-up contribution. This is a long-term retirement savings account, so if you need to access this before 59 and a half, you're gonna be hit with penalties. There's an early withdrawal fee, so don't poke the beast. While this might seem like an early juicy cash reserve, especially when times are tough or you're lusting after the new tech or new car, just breathe and wait and make sure you do not withdraw before 59 and a half. You'll not only owe taxes on the amount, but you're gonna also have to pay an additional 10% penalty. It's a nasty bite out of your retirement funds, and it's one that's best avoided unless you absolutely need it. Employer match, the 401k double-edged sword you can't ignore. The employer match, it's a tantalizing carrot that dangles on the edge of a stick called the 401k. It's the ultimate financial perk, the corporate world's version of BOGO, a buy one get one deal. But what if I told you the entire concept of the employer match is one of the most misunderstood aspects of the 401k plan? Yes, the employer match can give your retirement savings a turbo boost. It's the rare kind of magic that conjures money from thin air. If your employer offers 100 match on your contributions up to say 5% of your salary, you're essentially getting 100% return on your investment instantly. But here's the thing, the employer match is not a sweet cherry on the top, an optional extra that you can take it or leave it. It's the bare minimum. It's the basic entry ticket to a world of meaningful retirement savings. If you're not contributing at least enough to get your full match, you're leaving cash on the table. This is cash you've essentially earned. It's like getting a pay raise and saying, nah, bro, I'm good, keep it. It's not a casual perk, it's the first step in a critical part of your journey towards a comfortable retirement. It's your money, it's your future. Make sure you're not shortchanging yourself. And before we move on, let's talk about a nuance for those of you new to a 401k, vesting. It's the hidden catch of the 401k treasure chest. So you've been diligently putting your hard-earned dollars into your 401k, savoring the sweet taste of your employer match. But before you get too comfortable, let's introduce a wrench into this finely tuned retirement machine: vesting. Vesting refers to the percentage of your employer's contributions that you actually own, based on how long you've worked at the company. In plain English, it's the moment when your employer's contributions to your 401k are truly yours and owned by you. The rest of the time, it's just made up monopoly money, play pretend funds that can vanish faster than your vacation days if you happen to leave before the vesting period is up. There are two types of vesting schedules: a cliff and graded. With cliff investing, you own 0% of your employer match until a certain time period or date. This is often around 2 to 3 years into your job, and then suddenly, poof, you're 100% vested. On the other hand, with graded vesting, your ownership in your employer's match gradually increases over time. It's like developing feelings for a friend, growing a little bit here and there, more each year, until it fully blossoms into a relationship that you weren't expecting. But here's the kicker: if you leave the company before you're fully vested, you'll forfeit some, if not all, of the matching contributions. It's a sneaky way for employers to encourage loyalty and keep you in your cubicle for a few more years. It's essential to know your company's vesting schedule because, as tantalizing as the promise of an employer match can be, it could be a little more than smoke and mirrors if you're not careful. Don't just follow the money, follow the vesting and talk to HR. So now when you're contributing to your 401k, one of the first things that you're gonna have to do is figure out where you wanna put that money. What do you invest in this? That brings us to our next section, the investment selection, the 401k asset menu. The investment selection section of your 401k is similar to stepping into a lavish buffet. It's gonna be the smorgasbord of options tempting you to take a bite, but within this abundance, this can be an investor's worst enemy. What in the world are these assets anyways? Buckle up, we're gonna do a deep dive into the wild world of 401k fund types and the different assets that can be found within them. Most commonly thing that you'll be finding is stocks. Also known as equities, share, they're all the same beast. When you buy a stock, you're buying a piece of that company. You're like a mini capitalist owning a tiny slice of corporate America or beyond. Domestic versus foreign. In the 401k arena, we often will hear domestic and foreign stocks. It sounds fancy, but it's not that complicated. Simply put, domestic stocks are your home team. These are companies based right here in the Star-Spangled USA. They're your Apple, Microsoft, or Ford. They're the big names that you hear over the dinner table or in the evening news. Now, here's the deal with domestic stocks. They tend to be comfortable, familiar, relatively stable, making them a default choice for many investors. They're like the old sweater that might not turn heads, but it's warm, it's cozy on a cold day. And when it comes to retirement savings, that level of comfort can be a real asset. But let's spice things up with foreign stocks. These are the international players, the companies based outside the US, from China's Alibaba to Germany's Volkswagen. These stocks give your portfolio a dash of global seasoning and global diversification. Sure, foreign stocks can be volatile depending on market conditions, but it could be a way to tap into fast-growing economies, diversify away from the US market, and also a hedge against a potentially weakening dollar. Does this come with potential risk? Yes, it depends on the foreign stock. It also depends on the fund. It depends on a variety of different factors like economic instability, political upheaval, currency fluctuations. Those are all risks to factor for and account for. Next, we move into categories for these stocks. So things that you'll hear often are going to be large cap, mid cap, small cap. These terms come down to a company's size, specifically their market capitalization. Market cap is like a company's price tag or valuation. valuation on the open market. You calculate it by multiplying the number of outstanding shares by the current market price of one share. Here's a little bit more into these different categories. 1, large cap. These are the corporate Goliaths, the heavy hitters of a market cap of over 10 billion. We're talking about the Apples, the Amazons, the Googles of the world. They're established, they're steady, they're considered safe generally, but they can also be a bit slow. Like the tortoise in the fable, they won't sprint towards the finish line, but they're old, reliable. In your 401k, they provide stability. They're the bedrock of your financial safety net, and they might not give you those eye-popping returns, but they'll keep your portfolio steady through the market storm. 2, mid-cap. These are like the Goldilocks of companies, not too big, not too small, a market cap between 2 billion and 10 billion. They're past the volatile startup phase, but haven't quite reached that blue chip corporate titan status. They offer a bit of both worlds, some of the growth potential of small caps and the stability of large caps. For your 401k, they can offer a good risk to reward balance. They won't rock the boat too much and still have some room to grow. And then 3, small cap. These are the small guys, the underdogs, the Davids going up against the Goliath with a market cap of under 2 billion. They're often young or niche companies. Investing in them can feel like a roller coaster ride of thrilling highs and stomach churning lows. But here's the thing, once these companies hit their stride, if they do, the potential for growth can be explosive. In your 401k, they're your moonshots, they're your chance for the stars. But remember, the higher that you climb, the harder that you can fall. Again, risk manage and don't put all your eggs in one basket. Another category that you're gonna see is value, growth, and blend. So now we're gonna dive into some of the nitty gritty. Value stocks are your hidden gems. These are the seemingly undervalued companies that you believe are set to shine. They're like buying a vintage car at a garage sale, a little dusty, a little overlooked, but potentially a gold mine. Now, growth stocks are your high flyers. These are your companies that are expected to grow at an above average rate. They're the startups that are turning into unicorns, the tech companies that are disrupting industries. And then we have blend. It's just like it sounds. It's a mix of both value and growth stocks, and it's for those who like to have a little bit of everything in their financial diet and buffet. So remember, as I talked about these different stocks and their categories, that this is a broad generalization and guideline. While the size of the company can indicate stability and give you a sense of its potential growth, even the label on your 401k platform to give it value, growth, or blend doesn't tell the whole story. Even giants can still stumble, small players can shake up an industry, or still be a dud. Investing is not just about picking winners, it's about balancing your portfolio. It's about choosing the right mix of assets that matches your risk tolerance and financial goals. We'll talk more about this in asset allocation, but let's cover some other common assets that you're gonna see. Bonds. Bonds are like IOUs. When you buy a bond, you're lending money to an entity like a government or corporation that's promising to pay you back on your original investment, known as principal, at a future date, known as maturity. And in this time, it's gonna give you a steady flow of interest payments. So let's dissect bonds on their term length. First, we have short-term bonds. These are bonds that would be like the speedster of the bond world, usually maturing from like 1 to 3 years. Because they pay back quickly, they tend to be less sensitive to interest rates and thus a safer haven of bond investing. But remember, safety often yields lower yields. Not always, that's a nuance for a different video, but let's just keep it simple for now. Next is intermediate term bonds, maturing typically within 4 to 10 years. They're generally not as safe as short-term bonds, but not as risky as long-term bonds. They offer a balance of reasonable returns without extreme interest rate risk. But remember, reasonable is a relative term, especially when it comes to investing, which brings us to long-term bonds maturing more than 10 years, some going even up to 30 years and above. They offer higher interest rates, but beware, they can also be very sensitive to changes in market interest rates. When rates go up, long-term bond prices often fall, and they can be dramatic. If rates fall, these bonds will also give you capital appreciation on top of their interest payments. It's a little bit like a game of poker, thrilling but potentially disastrous. General advice is if you're young and you have a good risk appetite, you might lean towards stocks and hold a smaller portion in intermediate or longer term bonds for diversification. And then as you age and near retirement, you start to shift towards shorter term bonds for safety and then start to shift the percentages towards bond. Next asset class is REITs, real estate investment trust. They let you play landlord without the hassle of unclogging toilets or the maintenance or chasing rent checks. REITs let you invest in real estate without the hassle of owning physical property. They're kind of like stocks for real estate. Each REIT is a company that owns, operates, or finance income generating real estate. It's like a stock. You can buy and sell shares of a REIT on a major stock exchange. Investing in REITs can give your portfolio some real estate flavor. They're typically more stable than stocks and often pay out dividends, as they're required by law to distribute at least 90% of their taxable income to shareholders. This makes them an option for income-focused investors. Next is TIPS, which stands for Treasury Inflation Protected Securities. They're a type of US Treasury bond that's designed to help protect you against inflation. They're like your financial bodyguard against the nasty inflation gremlin that erodes your purchasing power over time. Here's how it works. With TIPS, the principal value of your bond adjusts with inflation. So if inflation rises, so does the value of your TIPS. This leads to higher interest payments over time because the amount of interest you receive is based on an adjusted principal. So while your friends are crying over their shrinking purchasing power, you can sit back and watch TIPS do their magic. Remember, TIPS is not a magic bullet against inflation. The returns can be very small and modest, especially in a low inflation environment. Emerging markets. These are going to be the countries that are going to be somewhere between developing and developed. The ones that are rapidly growing and full of potential but considered rough around the edges. These are what we call emerging markets. Think nations like China, India, Brazil, Russia. Investing in emerging markets is like dating a wild and adventurous person. It can be exhilarating, offer experiences and returns that you wouldn't get with a steady, boring, developed market. But it can also be more volatile as these countries often face economic, political, and social challenges. But here's the thing, they have the potential to be growing so fast, they could offer high return on your investment. So it's a bit of a high risk, high reward scenario, and it comes down to your own personal research and beliefs. Which brings us to commodities. Commodities are the raw materials that humans use every day. Think oil, grains, natural gas, cattle, sugar, and the list goes on. The bread and butter of global trade, and yes, it can be part of your investment diet. When you invest in commodities, you're betting on the future price of these raw materials. It's like speculating on whether your local grocery store will raise the price of milk, lettuce, and you're probably thinking, why would you want to bet on things like wheat, oil, livestock? And it's just simple diversification. Commodities often march to the beat of their own drum, meaning they don't always move in the same direction as stocks or bonds. So adding a dash of commodity is something that different investors like to add into their portfolio to diversify, to help spread their risk and potentially boost returns in different varying markets. Just remember, commodities can be volatile and is nuanced as well. Gold is a special type of commodity. It's not just used for making pretty jewelry or filling cavities. It's often seen as a safe haven, a financial comfort blanket that investors cuddle up with when the economy is looking scary. It's looked at as a hedge against inflation and as a store of value. Crypto. If you happen to be in one of the rare 401ks that's implementing this, you might have access to crypto, the rebel child of the investment world. And just a decade ago, no one would have thought that this wild child would sneak into a 401k. But here we are. Let me be very clear, investing in cryptocurrencies is not for the faint of heart. And let's face it, cryptocurrencies are notoriously volatile, swinging wildly in price for any and every types of reasons. So if you can stomach the roller coaster ride and believe in the fundamentals of crypto, it can be a rewarding adventure. But remember, don't gamble with your retirement money. If you're going to play with crypto, make sure it's a small and calculated risk and part of a bigger, well-diversified plan. Now let's talk about the general categories of high-level fund types that you'll likely see in your 401k. Target date funds. These are the lazy, good enough, one size fits all. They automatically adjust their mix of stocks and bonds and other assets as you age. Easy, but again, not always optimal. And next is actively versus passively managed funds. Actively managed funds have a team of analysts trying to beat the market. They're the Wall Street rock stars, but their fees can be high. Passively managed funds simply track a market index like the S&P 500, and they're the unsung heroes of investing and the wallflowers with typically lower fees. So that was a quick basic rundown of the general assets that you're going to see and the categories inside your 401k. Don't worry if that's a lot. No one expects you to understand the nuances, and there are complex strategies for each, but understanding these terms and being acclimated to them now will help you navigate the confusing jungle of 401k investing. Regardless of the assets that you choose to invest in, you always want to look at the expense ratios and fees. The silent killer of 401 gains. When it comes to your 401k and retirement savings, there's a silent killer lurking inside the shadows. Management fees. On the surface, these fees may seem small and inconsequential. After all, what's 1-2% between friends in the grand scheme of things, right? Wrong. Let's get one thing straight. Management fees sound benign, but over time, they can significantly erode into your retirement savings. Think of it this way. Every dollar that you pay in fees is a dollar less you have to invest and grow. So here's how it works. Management fees, often referred to as expense ratios, are the percentage of your investment that fund managers charge annually for their services. So if you invest $10,000 in a fund with a 1% expense ratio, you'll pay around $100 each year, regardless of whether your investment increases or decreases in value. But that's not all. The true cost of management fees becomes evident when you consider their long-term effect. When your potential compound interest is reduced by management fees, this could lead to a significant shortfall in your retirement nest egg. Let's use a hypothetical example to explain this further. This could exist in a parallel universe where there are two of me existing at once. Broke Jeff chooses a high-cost fund with a 2% management fee, while Smart Jeff opts for a low-cost index fund at a 0.2% management fee. Let's fast forward to 65 when they're about to retire. The difference is startling. Even though they invested the same amount, Broke Jeff's 401k balance grows to around 1.28 million due to the high fees eating into his returns. Meanwhile, Smart Jeff's balance with the low-cost fund grows to nearly $1.7 million. That's a staggering difference of almost $500,000 thanks to the impact of fees alone. Paying attention to these fees and choosing low-cost options like index funds when possible can go a long way ensuring that you're going to maximize your retirement savings. According to the investment company Institute and Morningstar, the average expense ratio for actively managed funds was around 0.55% to 1.5%. Whereas the average expense ratio for index funds that are passively managed were often around 0.2% or less, which means a lot more money that you can save if you switch from an active to a passively managed fund. Vanguard, one of the most well-known providers of index funds, reported that their average expense ratio across all their index funds was a mere 0.06%. However, these averages and the actual expense ratios can vary fund to fund, so it's always important to check the expense ratio for any specific fund that you might be considering. So please note that these numbers are also subject to change and could be different. So be sure to check up on the most up-to-date and accurate figures. And remember, while a difference of 1% may not seem much on the surface, when it compounds over decades of investing, it can amount to a significant fund, potentially reducing the value of a retirement folio by hundreds of thousands of dollars. Let's face it, your 401k isn't a playground for speculative bets. As much as I am a degen with NFTs and crypto, and I have a little bit of a portion for doing high risk things and investing in trading, I do not do that with my 401k. This is your future we're talking about. So what's the smarter move? It's a word that seems dull in the world of fast-paced finance. Diversification. It's the tried and true comfort teddy bear that's been there from the start and has been a loyal companion on this journey. A diversified portfolio reduces your risk by spreading it across different investments. For instance, if one sector or asset class underperforms, your entire portfolio won't take a hit. And another nugget to remember, most financial experts agree for long-term retirement savings that a broad, diversified mix of low-cost index funds often outperforms flashy, actively managed funds. And here is the other thing, is that most financial experts, these people actively managing their funds, when you factor in all the fees, the taxes gained from trading, and having to pay all of these expense ratios, which include their salaries and all of these other things that we're paying for behind the scenes, when you factor that in, most of these actively managed funds do not beat the market. Target date funds, flawed but good enough for lazy 401k investing. Target date funds are an investment tool designed to simplify the retirement planning. These cleverly marketed products are the financial equivalent of an easy button for retirement savings. You can choose one with a date that's close to when you want to stop working for good, and then early on, it's all risk, high reward. It's a gamble that you can afford when you're young, wild, years from retirement. And then what it does, it starts to adjust as your golden years creep closer and your fund morphs into the cautious, low-risk granny, shifting your hard-earned cash into safer investments. A perfectly timed switch, all automated, and with you just sitting back oblivious to the machinations and the complications behind the scenes. It's professional handholding at its best in a complex world of investing. You're essentially placing a bet on the assumption that these fund managers will make all the right moves at the right times on your behalf. While convenient, we need to talk about the flaws. First flaw is the illusion of customization. These target date funds are designed with a general approach in mind based on the investor's age or retirement date, but they rarely account for individual circumstances, risk tolerance, and financial goals. Your financial journey, again, is not a one-size-fits-all t-shirt, so while it'll keep you from being naked, it might not fit on you the best. Number 2 is the myth of the glide path. Target date funds typically adjust their asset allocation over time, moving from riskier to more conservative investments as the target date approaches. This is a glide path because it gradually moves along this path and it's just gliding there. This assumes that all investors will have the same retirement needs as they age, which again isn't necessarily the case. 3. The hidden price tag of convenience. Some target date funds come with higher fees and expenses, which can also erode your potential earnings over time. Sure, they offer convenience, but at what cost? Those are things you need to look at. Disguised disparity. Not all target date funds are created equal. Two funds with the same target date might have completely different asset allocations. This can lead to some funds being riskier or less risky than an investor might want to assume based on the target date alone. 5. Complacency trap. The simplicity of these target date funds can lead to investment complacency because it's easy to just set it and forget it, but this might prevent you from regularly reviewing your investment strategy and then making any adjustments needed based on how your life changes towards retirement. Now that we understand the various risks and flaws, let's get real for a moment. Not everybody is a finance nerd like me or a stock market savant or trader. Some of us just want to go about our lives, do our jobs, binge Netflix without having to worry about asset allocations and expense ratios. And you know what? That's completely fine. There's no law, there's no investment police that says you need to be Warren Buffett to retire comfortably. So that's where target date funds are fine. they're just good enough. Now, target date funds are often bashed by financial purists who argue about their lack of flexibility and potential for higher fees. They may sneer at the one-size-fits-all approach, touting the superior hand-picked portfolios and regular market watch. And sure, if you're into that sort of thing like I am, more power to you. But for most people, they'd rather spend their time doing other things. Anything other than obsessing over financial markets, target date funds is a blessing. This is how I first started until I became a full finance nerd, more obsessed with maximizing my 401k and investments. So this is still a good enough option. And it comes with a variety of benefits. First, setting it and forgetting it. One of the key features of a target date fund is they're designed to be an all-in-one investment solution. You can choose your fund with a target date close to your retirement, dump your money in, and then let the fund managers handle the rest. Your investment is automatically diversified and your asset allocation changes as you get closer to your retirement date. 2, you don't need a PhD in finance. Investing can be complex and it's easy to get overwhelmed. Target date funds simplify the process. No need to constantly watch the markets, read financial reports. The fund is designed to optimize your investment for your retirement date. And 3, risk adjustment is included. As target date approaches, the fund gradually shifts its asset allocation from higher risk investments to lower risk ones. This ensures that your nest egg is protected as you near retirement, even if you never lift a finger. So, are target date funds perfect? No. Do they have potential downsides? Sure. But if you're looking for a hands-off approach to investing for retirement, they're a pretty darn good option. Lazy? Maybe. Smart? Definitely. While target date funds can offer a level of convenience, it's a simplicity for those who want a hands-off approach to investing. It's still important to remember that not all target date funds are created equal. You're still gonna have to do some level of due diligence. So what about for the people who want to have a customized approach and dig into the weeds of creating their own 401k portfolio and starting to optimize it based on your own needs? My financial nerds, my brethren, let's talk about how to determine which assets to choose for your own personalized asset mix, also known as asset allocation. Asset allocation, your personal investment bespoke cocktail. Now we get to something a little exciting. Asset allocation, the heart and the soul, the not so secret sauce of your financial portfolio. If you're like a financial nerd like me, you like maximizing your 401k, or you like the thought of maximizing your 401k like I do when I'm min-maxing my Diablo 4 sorcerer character, this section is gonna be for you. And it's not this one size fits all beverage for the masses. What we're doing is making a meticulously crafted cocktail where every drop or asset has a purpose, and the taste of victory is simply intoxicating. This is where you're normally gonna hear typical finance people talk about walking down the beaten path. This is typically a dull blend of 60% stocks and 40% bonds. Like we talked about before, one size fits all for the masses might not be necessarily optimal for you. Asset allocation is about understanding your individual financial palette and then serving up an investment mix that doesn't just make sense on paper, but gets your financial taste buds and brain cells and returns tingling, potentially. So how do you figure out your own asset allocation? First, you need to understand what kind of investor you are. A thrill seeker who gets a kick from market swings? Or are you the cautious type who'd rather stick to the slow and steady lane? Because seeing your portfolio, even if it's on paper in the short term, drop significantly or vary between 10%, 20%, it's hard for you to stomach even if those are unrealized losses. This is what we're gonna call risk tolerance. It's gonna be as unique as your thumbprint. Assessing this can be a little tricky. There's plenty of questionnaires and financial advisors out there that can help guide you. And you're gonna have to consider things like your age, your income, financial goals, and your emotional ability to deal with losses, unrealized or realized. So what you can do is just Google risk tolerance questionnaires, and then you'll get a bunch of different things that you can work with. And I'll put some links in the description below. This is nothing concrete. This is very basic 3-question questionnaire. So don't put too much weight into it, but it'll help you at least try to guide you in the right direction. First question is around goals. What are you investing for? Answer A is long-term growth financial security. I'm thinking decades down the road. B is a balance of growth and stability. I want my money to grow, but I don't want to risk it all. And then C is safety. I'd rather protect my capital than chase huge returns. Question number 2 is on timeline. When will you need the money? A, not for 20 years. B, probably within the next 20 to 10 years. And then C, within the next decade. 3, sleep factor. How would you react if your investments took a 20 to 30% nosedive overnight? A, yawn. I'd sleep like a baby knowing the market ebbs and flows. 2, I'd be concerned, but I wouldn't hit the panic button. 3, I'd be reaching for antacids and seriously considering cashing out. Tally up your answers. Are you mostly A's? Then you have a higher risk tolerance. Are you mostly B's? Then you're somewhere in the middle, moderate risk. And if you're racking up the C's, you're likely a more conservative investor. Again, this is just a fun quiz, but take it with a grain of salt. Remember, this is just a starting point and engage for your risk appetite. To truly understand your risk tolerance and align your asset allocation with it, you might consider consulting with a financial advisor or taking a more in-depth quiz. Now that you start to understand a little bit of your appetite for risk, people who are younger and have ice flowing through their veins can handle the wild ups and the downs of the market. However, if the thought of watching your 401k balance drop during a market downturn gives you nightmares and cold sweat, then you may want to stick to a heavier allocation of bonds. Once you've got a handle on your risk tolerance, then you can start carving out your asset allocation strategy. If you're younger and have a higher tolerance for risk, you can lean heavier into stocks, especially those that are growth oriented, small cap, emerging market stocks. If you're older, more risk averse, you might want to swing towards more bonds or large cap stocks. A higher risk tolerance doesn't mean you should be gambling with your 401k. Think of it as being able to take calculated risk for higher returns. And I emphasize calculated because it means doing the hard work, the extra work, and the research between what the higher risk investments are, like emerging markets or crypto, for example, and then looking at the realistic gains. What are the realistic downsides and risks associated with those gains, and your risk tolerances being able to weather the storm, the volatility, and accept those downside risks for the potential gain. And even when you have a high risk tolerance, you need to practice risk management. This is an in-depth concept for a future video, but for now, you want to just always ask yourself, what are my risks? What can I do to reduce those risks or prevent them? I'm a crypto and NFT degen in trading and investing in these extremely volatile assets in my other accounts. And I believe in blockchain and Web3 in the long term, but I don't take those same risks inside my 401k. Partially, that's because I don't have access to crypto in my 401k. But if I ever did access, I would only allocate a small portion going towards Bitcoin, and I would only accumulate during bear markets when there's 2 standard deviations below the mean on a log chart. Yes, this sounds technical, so let's make this a little bit simple. Standard deviation is like a ruler for data. It tells us how spread out numbers are in a group, and if the standard deviation is small, it means the numbers are closer together. If it's bigger, the numbers are more spread out. Let's say we're looking at the heights of a group of people. The average height might be 5'9". The standard deviation helps us understand how much people's heights can vary. If the standard deviation is small, it means most people's heights will be closer to 5'9". If it's large, it means those people's heights can be all over the place. So when looking at Bitcoin, an easy way to look at this without having to have all these different technical tools is the website lookintobitcoin.com. And if you follow their Bitcoin rainbow chart, where they do the heavy lifting and place a log growth chart for you on Bitcoin already, we can relate this to the examples of height. So if we're looking at this chart, you can imagine the rainbow colors representing the different heights of people. So the dark blue or purple at the bottom represents the shortest 2.5% of people. So 2 standard deviations from the average or the mean represents extreme lows for Bitcoin's price. So why would I only invest in this area is because of a concept in trading and investing called a regression to the mean. And it's a phenomenon which just means that asset classes or things in general will tend to gravitate to their average growth over a course of time. So that when you're at extreme highs or extreme lows, those will tend to adjust back to the middle. And because we're on a log growth chart, what that growth chart is showing is just the progression of that trend of the highs and the lows of Bitcoin's growth and calculating out the different standard deviations. Tying this back to everything, why would I do that in the grand scheme of risk management and what we were talking about earlier? What is the biggest risk for investing in Bitcoin and crypto? It's the volatility and the massive swings. What does this mean? It means you don't want to buy the top of a hot crypto cycle and then see it crash 50 to 80% or more later. And where I got this concept from, besides other ways that I was trading and without getting too technical, Raul Paul put it simply best by explaining it this way. Raul is the CEO of Real Vision Finance and former executive of Goldman Sachs. And he says he would have made more money if he just accumulated crypto at market lows and held it instead of trading it. And for my own experience, besides trading NFTs, I experienced the same thing. And even though I was able to do successfully well trading and having that liquid cash, it actually would have made me more money if I just accumulated at those lows and held instead. All of this also has the assumption that crypto and Bitcoin is here to stay and is going to be moving into the future, which I personally have. So that's how I would risk manage my 401k portfolio if I were to put in a little bit of crypto. And so that's what I wanted to explain by taking calculated risk, is looking at what the potential downside is and then protecting against it as best as you can. And this accounts for my own personal finance situation because my risk management for my entire portfolio and how my 401k fits inside it, I treat my 401k as a hedge against my higher risk activities and investments inside crypto. The account that I know historically averages an annual rate of return around 5 to 8% for the standard 60% stocks and 40% bonds asset mix. So that's my benchmark and likely result. And looking at the current 401k performance, I'm on track to retire comfortably even if my crypto investments and trading completely flops, fizzles out, and just goes away. So how do I protect against this? I make sure that I was building and growing my 401k so that I don't need crypto at all to retire comfortably. So that's what I focused on. Do I need crypto to retire earlier? Yes. Would it suck if crypto completely blew up and I lost all my money? A resounding and utter yes. Do I believe it'll go to zero? At a high level for Bitcoin and Ethereum at least? No. But I can't predict the future, so I risk manage for it in various ways, with one being my 401k. That's how the 401k fits in my overall financial situation. It'll be unique to you and your own needs and goals, and so that's what you want to adjust for. And remember the golden rule: diversify, diversify, diversify. It's the financial equivalent of not putting your eggs in one basket. A well-diversified portfolio will contain a mix of asset classes, and you get to spread the risk among those investments in various sectors and countries. And again, sounding like a broken record with index funds, they offer a simple way to achieve broad market diversification. So focus on broad categories: stocks, bonds, cash equivalents, and within stocks you can diversify further: domestic, international, large cap, mid cap, small cap, growth, value. And with bonds, you can diversify among government, corporate, international bonds, and then the different varying lengths of maturity. What about believing in emerging technology or market? This is where investing gets interesting. You're convinced that, say, renewable energy or blockchain technology is the next big thing. You might choose to invest your funds and focus on those sectors. But be careful, this type of investing should still form part of a broader diversified portfolio, and be careful and understand the risk if you put all your faith and hard-earned money into one trend. Here are example asset allocations for your 401k. First one is Warren Buffett's advice. Warren Buffett's advice is to have 90% in low-cost S&P index funds and 10% in short-term government bonds that can work for your 401k, especially for young investors with a high risk tolerance and a long investment horizon. 2. Take the age-based approach. This involves subtracting your age from a number like 1 or 120 to determine the percentage that your portfolio should be invested. For example, a 30-year-old could have 70 to 90% of their 401k in stocks and the rest in bonds or lower risk investment. 3. The all-weather portfolio. Let's switch gears and turn to one of the sharpest minds in the investment world, Ray Dalio. He's not your average Wall Street honcho. He founded Bridgewater Associates, which is one of the largest hedge funds and has a knack for making bold contrarian predictions that often hit the mark. Ray Dalio's all-weather portfolio is on the idea of creating a diversified portfolio that should perform well across all economic environments. So here is the asset allocation he suggests. 30% in stocks. For long-term growth, you could use a low-cost total stock market index fund. 40% in long-term bonds, tend to do well when economic conditions are poor. 15% in intermediate term bonds, hedge against deflation. 7.5% in gold. Gold is a traditional hedge against inflation. And 7.5 in commodities. Other commodities can also provide a hedge against inflation. And here's some findings from Vanguard. Vanguard, one of the world's largest investment companies. And according to the Vanguard report, their investors' median stock allocation was about 88% for investors in their 20s, which gradually decreased to around 50% for investors in their 70s. Again, investing is not a one-size-fits answer. Your best asset allocation may look very different from these examples. This is just to give you some insight into what they're thinking so that you can create your own plan. The key is to create a plan that you're comfortable with and that you stick to. And when you're creating your asset allocation, you're gonna have to look at what different types of funds or investments to add in there. Which brings us to one of the most talked about and one of the most touted investments inside the FIRE community, low-cost index funds, which is the wallflower superstars of the 401k party. So picture this. We're in a room full of fancy, overpriced mutual funds, all shouting loudly for your attention, flashy advertising, claims of high returns, all with the allure of beating the market. And then now we're just gonna glance over to the corner, and there, unnoticed, unappreciated, stands index funds. While not particularly attractive, they don't boast, they don't promise to be the life of the party. But here's the twist. They are actually the real rock stars and the undercover MVPs, the low-cost heavy hitters that could be the secret to knocking your retirement plans out of the park. Index funds are the investment world's best kept secret, and they're the financial equivalent of driving a dependable Civic fuel-efficient car rather than a flashy gas-guzzling sports car. Sure, they're not gonna win flashy beauty contests, but they'll get you to your retirement goals safe and sound with some spare change in your pocket. So why are these unassuming funds the unlikely heroes of your 401k? First off, they're cheap, and in the world of investing, cheap is good. Index funds simply aim to mimic a specific index like the S&P 500, which means that they're going to be passively managed. Less active management means lower fees, lower expense ratios. Lower fees means more money stays exactly where it belongs, inside your account, working hard for your future. Secondly, index funds embrace the mantra of diversification. By tracking an entire index, they spread your money across a broad spectrum of companies. This isn't putting your eggs in one basket. It's like buying the whole farm or fractionalized pieces of the entire farm. And lastly, these are the tortoises in the race against the harebrained, actively managed funds. Slow and steady, they aren't trying to beat the market, they are the market. Over time, they have the history of outperforming their louder, more expensive counterparts. So next time you're looking at your 401k options, give a nod to these wallflowers. They might be the unsung heroes who will make your retirement dreams come true. Forget about chasing the next hot stock. Fancy mutual funds, sometimes boring is beautiful, especially when it comes to building wealth long term. And it brings us to an important concept, rebalancing, but don't micromanage, at least for most people. Over time, market fluctuations will cause your portfolio allocation to drift from its original percentages and composition. So regularly rebalancing your portfolio, perhaps once a year, is a good way to maintain your desired percentages and allocation. So imagine this, your original plan was to stick 80% of your 401k in stocks and then 20% into bonds. However, after a year of some bull runs and bear hugs, your stock allocation has swelled to 90%. Now you're exposed to more risk in your portfolio than you originally signed up for. Time to rebalance. Rebalancing is the process of realigning the weighting of your portfolio to stick to your original asset allocation. Think of it as a reset button that helps keep your financial ship sailing smooth. You're basically selling what's high and buying what's low to maintain the desired mix. Sounds a lot like buy low, sell high. But here's a question that gets asked a lot. How often should I rebalance? Here's the skinny. Again, there's no one size fits all answer. I know, broken record. Some finance folks recommend checking in annually, semi-annually. Others suggest a more event-driven approach, rebalancing only when your allocation shifts to a certain percentage from your initial goal. I'm all for a calendar-based approach. What I do is I aim to rebalance during the beginning of the year when I do an annual review of the previous year and I'm setting my goals and planning for the new year. And I also add in a mid-year rebalancing when I do a quick check to analyze how I'm doing and asking myself if I need to adjust. You could do the same or set a date. Maybe it'll be your birthday or tax day. You can make it an annual money date with yourself. And why do you want to do this? Because it removes the emotion from the equation and you won't get tempted from time to time with the market or try to react to temporary market jitters. Let's not forget that rebalancing might not be free. There could be tax implications, transaction fees involved. So ensure that you understand these costs before you do your rebalancing and put in the time and effort into it. You can just talk to your 401k provider and ask them upfront of what might happen. So as your life circumstances change, so might your asset allocation. Major life events, marriage, kids, new jobs, or windfalls could warrant a reassessment of your strategy. And as you get older and closer to retirement, you probably want to shift towards more conservative investments to protect what you've built. Roth 401k versus a traditional 401k, the ultimate showdown. Most people are going to try to feed you the same tired line. If you think you're going to be in a higher tax bracket when you retire, go with the Roth. If you think you're going to be in a lower tax bracket when you retire, go with a traditional 401k. But the truth is, it's not that simple. There's more to it than guessing future tax rates, which, by the way, we just don't know. The 401k is kind of like a charming bad boy of retirement accounts. It gives you instant gratification and gives you that sweet tax break up front. But just like a bad boy or girl that might leave you high and dry, the 401k has its sting in its tail and you're gonna have to pay taxes on it later when you withdraw in retirement. On the other hand, the Roth 401k is like a reliable, steady partner. There's no tax break up front, which can feel a little bit of a buzzkill, but just as a steady partner often proves their worth in the end, the 401k promises tax-free withdrawals during retirement. But just as a steady partner proves their worth in the end, the 401k promises tax-free withdrawals during retirement. So what you're getting is not a single penny goes to Uncle Sam and taxes when you're chilling in your golden years and retirement. But here's the rub. Neither of these options are going to be inherently better than the other. And I know that's not what you want to hear, but that's the truth. The decision between a 401k and a Roth 401k really comes about weighing your present benefits against future gain. It's about assessing your own personal circumstances to your career trajectory, your businesses, your retirement plan, and your overall financial plan. And yes, to some extent, trying to look into a crystal ball and predict what your future tax situation might be. Good luck with that though. So what it's not about is mindlessly trying to follow a one-size-fits-all piece of advice. Because in the game of retirement savings, the only size that fits well is the one that is tailored to you. You're gonna have to sit down, crunch some numbers, run scenarios, and just think about your goals and your future. And if you're not really sure, you can hedge your bets. Many plans will allow you to split your contributions between a traditional 401k and a Roth 401k, giving you the best of both worlds. Borrowing from your 401k. Tempting, but a little treacherous. Borrowing from your 401k might look like a soft pillow to cushion financial blows. After all, you're borrowing from yourself, right? Wrong. Let's call it for what it is. It's devilishly enticing, seductive, financial mousetrap. 1. Opportunity cost. By withdrawing funds from your 401k early, you're robbing them of the chance to grow. And as we've seen with compound interest, this literally could mean the difference between tens of thousands of dollars or hundred thousands of dollars. It's like picking an apple before it's ripe. Sure, you get an apple, but you miss out on the sweet, juicy fruit it could have been. 2. Double taxation. Although you're borrowing, the repayment isn't as straightforward as you think. You get to repay the loan with after-tax dollars and then get hit with taxes when you withdraw at retirement. It's like paying for the same meal twice. 3. Penalty risk. Lost your job, your 401k loan can instantly transform into a withdrawal, slapping you with income taxes and a 10% early withdrawal fee if you're under 59.5. 3. Loan risk and repayment. The IRS is not Santa Claus. There's going to be limits on how much you can borrow and also strict repayment schedules. If you fail to adhere, you're going to be welcome to a world of hurt, of taxes and penalties. So despite these financial horrors, borrowing from your 401k isn't always going to be a nightmare. If you're disciplined, you have a concrete repayment plan, it might work. But remember, this isn't a decision to take lightly. It's like a high stakes poker game, but the chips that you're betting with is your future comfort and security, so think about it wisely and act wisely. 401k and the job hopping dance. What is your next move? So you've been climbing the corporate ladder, getting promoted, switching jobs like you switch your Spotify playlist. Again, congrats. And now what happens to your 401k that you've left collecting dust with your old employer? Let's dive into this tricky terrain and let me tell you why cashing out is akin to sabotaging your financial future. When you wave goodbye to your old job, you're not just leaving your boring team meetings, questionable office coffee, you're also leaving behind your 401k. A chunk of your future wrapped in complex financial jargon, hidden under layers of bureaucracy. It's attempting to cut, run, and cash out and treat yourself, maybe a brand new car, a lavish vacation, but let's take a reality check really quick. Cashing out is like having a fantastic meal at a fancy restaurant, then deciding to go outside and puke it all out in the parking lot. It doesn't make sense. It stings your future self by triggering income taxes, and if you're under 59 and a half, there's gonna be a hefty 10% penalty to boot. So what are the smarter moves? 1, roll it over. Shuffle your old 401k into your new employer's plan. It's like taking your new favorite toy to a new playground. Just make sure you compare the costs and investment options. 2, the IRA dance. If you want more control, do the IRA shuffle. Roll your 401k to an IRA, an individual retirement account, and it can open up a world of more investment options. It's like graduating from a tricycle to a racing bike if you want the options and your current options are not good enough. 3, stay put. This is the do nothing approach. Sometimes laziness does pay off. If your old plan has amazing investment options at low cost compared to your new employer, then why not? If you're going to be saving a lot more money in fees in the long run. So remember, as you climb the career ladder, don't forget about your 401k and make sure to roll it over when it makes sense or keep it there and still keep track of it because this is still a vehicle for your retirement. All right, folks, we just ripped off the cover on the 401k. So you're a little older, a little wiser now, but don't let the journey end here. We have a lot more truths to uncover and your financial freedom is at stake. So what's next on our hit list? Next videos include Roth IRAs and my favorite, investing in the Wild West of crypto. You don't want to miss out, so smash that subscribe button, join us for the ride, and as always, take care. Talk soon, and I'll see you in the next video.